Top 3 things in my notebook this morning. Number 1, volume. I'll give you a hint on what that's going to be about. There is none. Point number 2 is going to be the bond market, and point number 3 is going to be the Italian stock market. So again, looking at things on an interconnected basis, as you should. Now, number 1, volume. If you look at volume, again, we've been talking about this throughout the year. Volume is obviously crashing from a secular and cyclical perspective, but you also have this dynamic duo of on down days volume accelerating and on up days volume decelerating. So again, yesterday you get a U.S. equity market up move and you get down volume on a 1-month basis of 16%, and if you push your horizon out to 3% or 3 months, it's down 29%. So again, dramatic asymmetry developing in the up price, no volume move as fund flows in U.S. equities, don't forget, have gone negative relative to bonds, which are now seeing a resurgence in inflows. They have for more than a couple months at this point. So again, there's a bull market in bonds. We're much more comfortable in that. We want you to stay away from buying stocks at the all-time high. Now, the second point, I already made part of that on the 10-year bond yield, making new lows for the third quarter here, and our third quarter theme remains Q3 slowing. We think the bond market gets it. We think the consumer gets it. We showed real wages this morning as our chart of the day. So if you look at real wages, again, what people make versus what they have to pay for things, and again, on a real basis, the consumer's spending is going negative. So again, in a real consumer spending environment that's going negative, you're going to get less growth than what consensus thinks. Now, as consensus continues to take down their growth estimates, bond yields are going to continue to fall. Now, most people still aren't bearish on bond yields like we are, so we suspect that they're going to continue to go lower until they capitulate on that. Now, finally, Italy, whether it's Darius's pop-up or whatever it is that was going on there, so you could look at the European equity market. It's trying to pop up, but the question is what pops up and at what level? So again, is there going to be any volume, by the way, even if they do get above the levels? For now, currently the Italian MIB index is trading significantly below its trend line, and that's new as of the last couple months this has been manifesting. So again, if Europe slows into the summertime, and again, rate of change is what we're talking about, you're going to see breakdowns in that equity market premium that we used to like in Europe. Now, with both the euro, the currency, and these equity markets breaking down below their trend line, I would not ignore that signal. This is Hedgeye playbook. It's a risk management signal, and we like to go both ways. When we start to short European equities, which we haven't done yet, we're just not long them like we used to be, is the next question. So those are your top 3 things.